Hello everyone, I'm Ubina Kapasi and I have with me Harsha Upadhyaya, Chief Investment Officer with Kotak Mutual Fund. We're here to discuss the November equity outlook. Harsha, thanks so much for joining us today. And we are meeting at a time when, of course, geopolitical tensions are grabbing the headlines. Markets as well are a bit circumspect about that. But then we have the US Fed too, whose commentary is something that's moving the markets quite a bit. How are you reading into all of these factors and which, according to you, is the biggest market moving factor right now?
Clearly, we have a cautious stance on the markets as of
Okay.
now. As you spoke about geopolitical issues, that's definitely one of the issues that we have been watching closely. We already had a conflict between Russia and Ukraine going on for last 1.5 years. We have already seen one more conflict emanating from Middle East. As of now, none of the oil-producing nations have actually got involved in the war between Israel and Hamas. But in case some of the oil-producing nations get involved in this conflict, or some of the Western nations get involved in the conflict, then probably markets would get even more nervous than what they are today. As far as US Fed is concerned, I think clearly their commentary suggests that the rates are going to remain higher for longer. Recently, we have also seen 10-year US Treasury yields touching a psychological mark of 5%, and they are trading at around the currently at around the same levels. So clearly, market is also worried about the pace of the interest rate movements or the yield movements that have happened in the Western economies. So that's going to be a negative for almost all of the emerging markets in general, and also for other asset classes other than fixed income. Apart from these two factors, we should also remember that the valuations are not so attractive in the Indian markets as of now. While on the Nifty side, when you look at large cap index, the valuations are probably at around fair range of valuations. But however, if you look at the broader end of the market, the valuations are not at comfortable levels. They are quite expensive. So to that extent, what happens to market would also be determined by some of these valuation risks in the next few weeks or months. Apart from this, we should also keep in mind that the foreign flows, which were kind of very, very strong for the last 6 months or so, have turned negative in the last couple of weeks. So to that extent, that could also kind of increase volatility, especially at a time when the valuations are on the higher side. So all in all of these factors would probably drive markets going forward.
So we've discussed the global factors. Now let's shift the lens back home. In terms of domestic factors, corporate earnings, so far, we're in the thick of it. How are you assessing how India Inc. has done in the second quarter and the commentary for the future outlook?
Clearly, India growth story continues to be intact. We haven't seen full range of results for the second quarter of this financial year, but about 30% of Nifty basket have actually announced the results. And if you look at the basket of companies which have announced results, the results have been ahead of expectations. And at the PAT level, the expectations have been beaten by about 4 to 4.5%. As of now, these one-third of Nifty basket have actually given 30% plus year-on-year growth in earnings. As you go ahead in terms of earnings season, as you see broader companies announcing results, probably this number would decline. Our expectation is probably we will see about 21% year-on-year growth on Nifty earnings. And if the current trend continues, probably we'll be able to beat that kind of earnings. When you look at mid caps and small caps, however, their earnings growth rate has been much higher than Nifty basket. Even now, when you look at the market, I think that's going to get achieved. Maybe there is some red flag in terms of higher inflation eating into profitability margins in the next 1 or 2 quarters, given that some of the commodities have moved up beyond comfort levels in the recent past. However, when you look at the medium-term earnings growth for Indian companies, that continues to be very healthy and somewhere in the mid-teens. So overall, I think earnings season is unlikely to really spook the markets. The valuations may, at some point of time, create some volatility in the markets. However.
Let's talk about another factor back home, which is a positive, the inflation number. It gave us quite a positive surprise. But do you think that that is something that will move the needle a lot, especially because many are saying that this could be temporary? The Middle East conflict could sort of find its way into the crude market, and that in turn is something that will again affect India's inflation.
Inflation and interest rates were the center stage for markets for the last several quarters. However, as of now, it doesn't seem to be the only factor which is driving the markets. Yes, we have seen some cooling off of inflation. And as you rightly mentioned, probably we need to keep watching that space as some of the commodities have moved beyond our comfort levels. For example, crude itself, without much of fundamental reasons, actually has moved up 35% from the bottom. And we haven't really seen the full impact of the Israel-Hamas conflict yet on the oil prices. So to that extent, definitely that's something that needs to be kept in mind. Secondly, we had a very deficient monsoon this time around. Deficiency was about 6%. Historically, whenever deficiency has been 6% or beyond, we have seen a temporary impact on the food inflation part. So that is also something that we need to keep watching out for. All in all, currently inflation is not such a big worry, but it could become a worry if the current trend continues to move in terms of higher commodity prices or monsoon affecting food inflation, etc.
So, what is the strategy you would ask equity investors to deploy right now?
We have been advising equity investors to invest in a staggered manner and invest for a longer term. As we spoke earlier as well, India growth story continues to be intact. And if somebody is investing for 3 to 5 years from here on, definitely there is a good earning story that's going to unfold. And from a longer term perspective, at least on the large cap side, the valuations are quite reasonable and fair, I would say. Although one cannot say the same for mid caps and small caps, where we believe the valuations are on the higher side. So to that extent, probably the portfolio needs to be tilted towards large caps. And if you have a slightly large capish portfolio, and if you are investing for longer term, I think there is a reasonable degree of confidence in terms of making reasonable amount of money over the medium term. However, if you still want to invest in mid and small caps, we would advise that you should go only in a staggered way, and also keep in mind that whatever past returns are there, the recent past returns may not continue to be get repeated, and to that extent the volatility could be higher. So if you're okay with higher interim volatility, probably taking some exposure in mid and small caps is also not bad. However, as a overall risk reward equation suggests, a slight tilt towards large cap is what we would suggest.
Larger valuation risk for mid and small cap stocks versus large caps. But the end conclusion is invest in a staggered manner. Thank you so much for joining us.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.